It's a brand new year, and how is gold set up this first trading week of January? Joining us now is the CEO of the Investment Advisory Europe Pacific, Peter Schiff. Thanks so much for being back with us.
Well, my pleasure. Thanks for having me on, and Happy New Year to you and to your audience.
Happy New Year to you as well, Peter. You are known for making very bullish calls on gold. How do you see the metal set up here as we start off this new year?
I think it's set up quite well. You know, we've had a lot of negativity on the price of gold. You know, people were expecting it to drop a lot more than it actually did decline last year. And this year is beginning with a lot of negativity as well, although the price action so far early in the year looks quite encouraging. But I do believe that what was driving gold lower for the last several years, and I think it's been down 3 years in a row, was the false belief that what the Fed had engineered was a legitimate economic recovery in the United States, and that higher interest rates would be supportive of the dollar and detrimental to the price of gold. All this is wrong. All the Fed has done is inflate a gigantic bubble, which may have already popped. And I think rather than delivering the rate hikes that everybody expects, I think we're going to get rate cuts and another round of quantitative easing that will be even bigger than the prior three. And I think gold is set up for another spectacular rally. I think it's going to see new highs. And I think the biggest leg of this gold bull market, which really began in 1999 with gold below 300, I think the next leg is going to be the biggest leg.
Peter, you mentioned a QE4. Is this a possibility we could see in 2016?
Well, I think it's an inevitability that we're going to see it. And I do think it's likely that it will start in 2016. But if somehow we make it through 2016 without another round of quantitative easing, then we'll certainly get it in 2017. But I still think that 2016 is a more favorite because it is an election year. And, you know, earlier today, the Atlanta Fed reduced their forecast for the fourth quarter GDP in the U.S. to just 0.7. I have a feeling that it could end up being negative by the time we get to print in a couple of weeks. And if we have a negative fourth quarter, there's also a good chance we have a negative first quarter, which puts the U.S. officially back in recession. What is the Fed going to do in a recession, especially in an election year? They're going to pull out all the monetary stops. They're certainly going to do more QE. And I think we could see a big pickup in the unemployment rate in 2016 as we start hemorrhaging some of the jobs that never should have been created in the first place in the last couple of years. And so what is the Fed going to do in the face of a weakening economy and rising unemployment? We know what they're going to do. They've done it before. It doesn't work, but that hasn't stopped them.
Peter, getting back to gold here, you have been quoted as saying that twice in the last 15 years, the U.S. stock market lost more than half of its value. That means it was down more than gold. You've been criticized for your $5,000 gold calls. What's your main message to critics here?
Well, I think the critics have to put everything in perspective. You know, I've been recommending gold as a way to hedge yourself against monetary policy mistakes since the late 1990s. And, you know, gold rose from under $300 an ounce to close to $2,000. And it has had a multi-year correction as everybody has falsely anticipated a successful conclusion to the Fed's monetary experiment. I think these bets are wrong. They're the same types of bets that people were making when they were buying subprime mortgages or when they were buying the dot-com stocks. But the price of gold has gone down because most people who are trading the metal don't perceive reality yet. They soon will, just like they did in the prior bubbles. And I think when the fundamentals or reality finally rears its ugly head, I think the price of gold is going to rise very rapidly. And I think there's a lot of people that are short the metal, and I think they're going to be very surprised by the magnitude and how swift the losses actually materialize. And I think that people need to make sure they're positioned properly long this market before that turns around.
All right, Peter, finally, at these levels, is gold a buy for you now then?
Well, look, obviously it's a buy. It's below 1,100. I think it's a great buying opportunity. Sure, I said that a year ago, and you never know exactly where the bottom is going to be. There's certainly a lot of evidence out there that we're close enough to the bottom that it doesn't make any sense to hold off for lower prices, because I think the upside potential in gold dwarfs what the downside risk is. And I do believe that potential could be realized very rapidly. So I think it's going to be very hard for people who aren't positioned to chase the market once it runs away. I think it's much better to be prepared in advance. Yes, sometimes it's difficult because you're buying and you're not getting that immediate validation because the market is headed lower and everybody thinks it's going to keep going lower. But I think that what you have to do is understand the real fundamentals and buy before everybody agrees with you. because by the time everybody else understands that they need to be buying gold, believe me, the prices are going to be a lot higher. And then my critics who, were all over me for saying $5,000 gold, they're probably going to jump on the bandwagon when gold is a lot closer to that number.
All right, Peter, thanks so much for your thoughts.
My pleasure.
And thanks for watching this new edition of Kitco's Gold Report. We'll see you tomorrow. Thanks for watching.